Corn exports running well ahead of pace.
Hi, everybody. Welcome back to the CommStock channel. I'm Marlin Bohling with you. As always, make sure that you like these videos, subscribe to them by clicking on that bell icon down below, and share these videos with others as well. Appreciate your support as we continue to grow our audience each and every day, so we thank you for your help. I'm joined today by Joe Camp of CommStock Investments. And Joe, not a great start to the week in the grain commodities. We had the grain condition report, I guess you would call it crop progress, and the condition report that came out from USDA on Monday. Did it do the market any favors, or does it just add to the confusion now?
Those ratings were a bit of a spark for a turnaround Tuesday of sorts early in the session, moving higher. I would call it in part response to the crop ratings being down on the week. We're looking at both corn and soybeans, the good to excellent scores together, both crops down 2 points. We're looking at them still being well ahead of last year, but in a downward trend now from the start. And that's been the theme here, thinking that for as high as we started on corn, that you've got maybe only downside to go, unfortunately. Still plenty of weather risk ahead here this summer, whether it's from conditions staying way too wet in places or for the crop drying out and it turning a lot hotter as well here as the summer rolls forward. The few notable points here we can bring up: ratings map. We published this morning in the CommStock report. We've got look at the corn condition ratings at 72% good to excellent. You see that both Illinois and Iowa are at 74%, so holding pretty strong. A big break lower, though, of 9 points for that score in Illinois. Ultimately pretty good, but again, under the threat. Maybe they don't mean that much to predict yield at all, but if it's the trend that we're reminded each week of this weather risk remaining, that's what we have to keep note of. If I show the soybeans, it's a similar picture where, again, they were down by 2 points for the total score at 70% good to excellent. You can see, again, that's well above last year at 54%, but on the move lower. I think I'm reminded, though, or want to remind everybody, of course, about how these ratings are subjective. You've got the crop scouts out there. The USDA says there's about 3,600 of these so-called industry experts that have a look at the crop on a regular basis and doing a windshield tour and writing their scores down. I think as it's subjective, you can rate what you can see, right? And this would go into some of the weather issues that we're having still, where if it's underwater, not yet emerged, then you're not going to be scoring that to some extent here. And we're seeing that, I think, early on in these ratings.
You know, looking at that graph that you had up there, it looks like the highest ratings are in the northwestern half of the Corn Belt. And that's right where they're supposed to get the heaviest rain again later on this week, right?
That's right. And it just won't quit for some of these areas that already had their wettest May on record. And so extension of these heavy showers into the month of June. We're talking about a large portion of northwest Iowa, southwest Minnesota, southeast South Dakota. So, that's a continued risk that not only was the crop mudded in places, but then it continues to just be so soggy, humid, and eventually hot. And that's potentially one saving grace for those that aren't getting the heaviest of showers, is that the rain hasn't quit. We're still seeing off and on showers in places while the temperatures are heating up, and that's helped shoot this crop up in places. So it's variable, just as the planting season was so off and on and staggered and variable. That's how the early growing season is looking for sure.
And the big money funds, they still seem to have the attitude rain makes grain no matter what.
That's definitely the case, and we've observed that with the latest price slide, which has now left these hedge funds back with really hefty bearish bets again, over 200,000 contracts of corn, and moving back sharply lower again for soybeans and wheat as well.
Well, I'm glad you brought that up. I believe you have a July corn chart. I'll let you go ahead and pull that up. I wanted to talk about that a little bit here on the July corn. Of course, it's kind of running out of time here, but when you look at that chart, it looks to me like we are actually under some some key support levels there. If you look at some of those moving average lines, and now you're looking at your Bollinger Bands there, it seems to be kind of hugging the bottom, and it's a little concerning. They took out that one moving average line, is it not?
Yeah, a good way to transition because we're talking about hedge funds that are obviously really sensitive to what's going on the charts. Their computer algorithms trading a weakness here all of a sudden with support turning into resistance at those middle of the range moving averages. We can see on a Tuesday, corn having come up for a test of that 100-day moving average in yellow. Just ahead of that is the 20-day moving average that splits those Bollinger Bands to the bottom Bollinger Band. If we're not able to recapture quickly this support from the middle of the range, you've got anything under about 437 probably opening up a real quick drop, unfortunately, down to $4 even, and a test of that potentially psychologically important level of support. For now, again, a bounce. It really looked rather friendly just Thursday last week, so you can see how quickly these markets can change, of course, but ahead of the middle of the range, bouncing from that 20-day moving average, and then on Friday, just giving all of that up and then some, and then positioned here as we started off the week negatively because of being below some of those key levels. The hedge funds are going to be watching this chart closely. Another thing that's important for July corn futures is to bring up how close we are to this contract coming into the delivery period. And what that means for speculative positioning, commercial hedgers as well, having to move positions out. Our farmers rolling reownership longs, for example, or thinking about how to hedge the remaining old crop inventory that they have. We'll have options expiring on Friday this week, and then first notice day coming up on the last day of the month, which is also that really important crop report day. So a lot coming to a head, if you will, here, probably to continue to support expectations that we're going to be in a very volatile period for these crop futures.
Do you think this market might go kind of flat ahead of that report on the 28th?
You would think normally we get into a quiet period as we wait for those numbers. This one could be different. We've got we'll be reminded a shortened holiday trade this week off for Juneteenth on Wednesday, and then just a day and a half or so to position ahead of the close on Friday for those options to expire. We showed the chart where corn futures not only were testing this area around the 100-day moving average, that point though also coinciding with 450 even, which can be an influential factor as we approach options expiration. And there's that pin risk of whether or not we're going to be above or below 450, which is a pretty heavily struck option strike contracts, option strikes. So all of those, yeah, again, coming to a head this week and maybe generating some more than usual activity ahead of the options expiring and ahead of then now next week on Friday, the big crop report day.
Now, I did want to ask you, do you think corn is maybe a bit of a dark horse contestant here this year because of the exports that we have seen on corn versus the exports that we have seen on soybeans? I know soybean exports have been, the sales have been running behind quite a bit. Corn actually running ahead. I know the market doesn't look all that great right now, but it could be a lot worse, couldn't it?
Corn exports running well ahead of pace, not just pace for last year or a recent modern average, but for the USDA's target as well. And we think about back to last week, the June crop report disappointing the corn bulls because it did not produce, well, for one, any changes to the balance sheet, but more particularly, no revisions upward for the demand estimates, which whether it's exports like we'll talk about here or ethanol as well for that matter, both of those categories of usage are currently doing better than where we would need to be to meet the USDA targets. And so back to exports, that's the glaring example of a revision higher that the trade would expect to see that would still take away from old crop inventories. And that comes into play as we're anticipating this quarterly grain stocks report. But the real driver of corn exports at the moment is going to be those to Mexico, up so sharply, looking at a record high this year and making up for the lost business with China. So corn exports outstripping and surpassing what a business we've lost to China. You can see in this graphic in red the current year corn export sales compared to the previous year in blue, and the 5-year average in green, just well ahead of recently and any sort of average that we've been looking at previously. And so that's really supported corn basis for one. You have in the Western Corn Belt for sure strong ethanol demand throughout the north, but then everything going south, drawing into a really hot feed market, and that feed demand having to compete then with these trains for corn exports heading to Mexico. And so we see still old crop basis pushes really helping out here. And you talk about corn exports to Mexico being up. One big reason is going to be this drought that we've got expanding in Mexico. You can see that on the drought monitor, those pockets of severe to extreme and exceptional drought. And that's a continued risk, not just for the current demand that Mexico has, but for their new crop. And we start to already see some business out to our next season for corn exports. All of that, a pretty underlying bullish factor for old crop corn.
Well, you don't have to go too far south of there on the map. And we've all heard the stories about the drought in Panama causing problems with that Panama Canal, just because that lake is so low and can't be replenished. So it seems like the problems are still continuing. According to the INSO update, the Climate Prediction Center, they do think that we're going to roll over into a full-blown La Nina by the end of summer, maybe into the fall, definitely by the winter. So maybe the moisture trends will shift a bit, between now and the end of the year. That's for sure. What about the election that took place in Mexico? Do you think that will change any of the dynamics in the corn exports?
That's going to be a key issue in the months ahead. It's been historically the case that we expect to see some upside during election years. In the run-up to November, commodity prices usually perform well, and that can mean bucking the seasonal trend for the grains and having some late summer strength. But this election's different, right? And most particularly because both candidates really for the presidential election, I believe, are going to posture against China. We've already observed the Biden administration enacting new tariffs. We know about the tariffs of the previous former President Trump. So it's going to be, an interesting feature. I would think that we get to a point where we're talking up negativity regarding the reaction, but the proof is in the pudding, and that we actually continue to see, despite all of that, China wanting to stock up and expand its imports, which they're going to have to rely on the U.S. for, I believe, still in the time being.
Okay, now I want to shift gears here for a little bit and talk with you about the big moves that we have seen here in the meat markets, namely in the cattle market. It just seems a little odd to have them flying so high this time of year. And I just wondered how long that can continue, or do you think we're getting up in rarefied air this time of year where it will be hard to keep that juggernaut going, I guess you would say, toward the upside?
The strength for cattle futures can continue as long as the beef prices stay as firm and resilient, really, as they have been. But that's important to note, the seasonality of it and the timing of the year that you bring up. If we look back just to last year, this is a playbook that we've got to watch out for. It was the second into the third week of June that beef prices really started strengthening, even the choice average reaching into the low 240s. We have that potential that buyers are really scrambling for coverage into a strong summer marketing season that we would still expect for beef. But yet it gets to a point now that we're past Father's Day, now that we're pretty quickly just a couple of weeks out from the 4th of July holiday, that seasonality breaks into play here, and we've got to take a breather for this market. Overall, I generally expect that that's the case, that we continue to run higher while the strong cash market supports a convergence of the futures higher towards the end of the month. But then we're talking about being left vulnerable to a correction of sorts here during the summer months. A lot of that, too, will ride on here right up ahead, the cattle on feed report coming out Friday.
Do you think it's setting up for cattle and hogs to do a bit of a promenade, if you will, and role reversal, and to turn those two around and maybe go opposite directions again?
I think that can be the case when you look at the speculative positioning, still maintaining quite a large, relatively large position in the live cattle futures, still net long in the feeders as well, but almost having erased that net long position in the hogs throughout this latest slide. It gets to a point where we talk about the cattle having caught upward in convergence with the cash, but now here all of a sudden as well, the hog futures having come down and met the cash trade here. And pork, like beef, is remaining rather resilient here at the moment. And so the recent price slide for hog futures, when paired with that stronger pork, has supported packer margins in a way that I think stems further cash weakness for now. And maybe the opposite of the future trend here for cattle, with signs of herd expansion starting to gain traction this year. We've still got at least through the summer and probably a little bit into the fall where hog production numbers are expected to tighten. So that could help that flip of strength to benefit the hogs.
Well, I thank you for joining us here. We're normally talking on Wednesday. Wednesday is going to be a little different because there will be no markets because of the Juneteenth celebration this year, falling in the middle of the week. So federal offices are closed. The markets will be closed. Do we have evening trading sessions that will take place tomorrow night?
We do have, as for the grains, a normal Sunday, or I should say, a night open at 7 p.m. Central.
All right, so kind of a typical Globex market. All right, well, thank you for explaining that. I appreciate that. And then we'll get our next daytime session then coming up on Thursday. Well, thanks a bunch. I appreciate it, Joe Camp of CommStock Investments with us, and that'll do it for this episode. Again, thanks for tuning in. Appreciate the support. For producer Brian Hendrickson, I'm Marlin Bohling. We'll catch you next time right here on the CommStock channel. Thanks for joining us on our CommStock YouTube channel. Don't forget you can also find us on Facebook and TikTok as well. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.